Good evening, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hopefully you guys are doing very well today and that you had a decent day in the market in spite of today's very large sell-off. So the title of yesterday's video was that the stock market was at a very critical level coming into today and that the Fed meeting was going to be make or break for the markets. Well, the break happened much before the open. It was a very wild day to be considered. Now, into the pre-market action, we had a couple different things here. Israel striking Iran's gas fields, and that was a big no-no. You wanted to kind of avoid that because it would lead to further escalation, and quick little hint, it did. Iran retaliating on their own, hitting different gas fields in Qatar and even targeting some facilities in Saudi Arabia. And thereafter, around that same time, we got some pretty bad news out of the producer inflation numbers. Now, the market was able to stabilize midway through the day, but then came Jerome Powell, and we did decline. However, it wasn't what he said that made the markets decline. It was rather what he didn't say. The Fed also dealing with a tremendous amount of uncertainty right now, and that lack of clarity and the lack of confidence from the Fed definitely did have an impact on the markets. And as you can see, the S&P closing at the very low of the day. The futures market right into your 200-day EMA, and the QQQs largely the same thing, closing at the very low of the day and coming very close to a critical point in their own market structure right now in terms of the technology stocks. So in today's video, we're going to recap everything for you. Number one, we're going to go over many news headlines that transpired today and why they may be important to our analysis, especially now that we know there's a bit of an escalation. We know that previously the oil and gas fields of Iran were supposed to be untouched if you wanted to avoid any further escalations. That's not the case. It's getting a little bit hot in the kitchen right now in the Middle East. And of course, we have many other news headlines to get to, and we'll tackle the PPI report and also several comments made by Jerome Powell and the Summary of Economic Projections. So part number one, news recap and the highlights of the day in terms of that aspect. Number two, we got one big earnings to go over. And of course, that is Micron. Micron coming out after the close and posting some of the best earnings that I've ever seen in all my years of doing this. So fantastic earnings by Micron. However, that stock in the after hours is currently down by roughly 5%. And that's an indication of something. And we're going to talk about it too when we go through their earnings. Number three, we'll do a technical analysis rundown of the SPY, the Qs, and our major indexes. Market breadth is very low right now, collapsing from the bounces on Monday and Tuesday, which were the rally relief bounces, not the trend change bounces, but very clear in saying the rally relief bounces over the past few days. Market breadth is now lower. The VIX is also expanding. So we'll do a quick little index rundown, breadth rundown, fear and greed rundown as well, and different terms and different things in terms of market positioning. Thereafter, we'll get into our big tech list down here, and you can see that it was very much a bad day for big tech today. So once again, we'll go through this analysis and see which of these trades or which of these stocks are good to trade and how we can trade them, and also which of them are great adds for a long-term portfolio and at which levels. At the very end of the video, if we have time, we will cover the biggest gainers and losers of the day. There wasn't many winners. I mean, there was a few. There wasn't many, but there was a few. And then to the downside, a lot of different names for various different reasons. So we'll talk about it at the very end of the video. But today is going to be a very action-packed video, guys. So I'll try to get through the information as quickly as possible without speaking at 5,000 miles per hour. Let's get right into it, shall we? So the S&P down 1.4, the Qs down 1.4 as well. The heat map, not very good at all. No major sectors were participating in the market at all today because of the renewed inflation fears, because of the spikes in the price of oil and the possible extension of the duration of conflict and the escalation of the conflict. Consumer defensives and some of your interest rate sensitive and inflation sensitive names were not doing too good. Tech, by large and by far, also very weak. Now, early this morning, before Powell, it was somewhat of a mixed bag. However, after Powell, everything kind of unraveled here at the same time. Semiconductors down, big tech down as well. Financials really got hit hard today overall too, because of the premise of possibly keeping rates higher for longer in terms of this environment right now. Healthcare also not performing very well at all. We know that they've accelerated moves to the downside over the past week after losing a bit of their top end of the support range, and it's coming down really hot into a key support area. And the bottom half of the market, many of which are exposed to interest rates indirectly or directly, also came down. The one-day relative performance looks like this. Only energy actually made some gains today. Some of your natural gas names performed really well today. But by large and by far, that's the only bit of green that you actually had. Everything else significantly to the downside, and even basic materials. And we're going to talk about this when we go over gold and silver, because many people believe gold and silver to be a safety trade in times of uncertainty. But I've been through this many times, guys. When the actual safety trade is cash, you will find some profit taking even on the commodity trades, which are supposedly supposed to benefit from inflation, right? That's not the case right now. So you're seeing many things, such as the dump after Micron earnings, even though they were phenomenal earnings, and the collapse in the prices of gold and silver, losing key areas of structural support right here, which also gives us an indication that the market is currently positioning, was already positioning to risk off. But today was kind of a dagger, right, across a lot of different names right there. So please keep that in mind. Basic materials not doing too well. 1 week relative, only energy and utilities making out of the batch alive. Everything else, unfortunately, to the downside. Fear and greed index right now at extreme fear reads of 18. It was in the low 20s earlier this week. Market momentum below its 125-day moving average, which is what CNN uses to derive this indicator right here. Stock price strength has been falling off ever since the conflict began. Stock price breadth continues to fall off even more at the current time, hitting oversold levels across the board, but we had a couple relief bounces Monday and Tuesday, but it was not enough. Basically, the bears kind of swallowing all of that price action today, and put to call option ratio continues to be in extreme fear territory as people flock to more and more protection. Even though there's the most amount of protection in the markets currently since Liberation Day, people feel the need to want even more. So what exactly happened today in terms of the PPI report? Because it was not good. And that was one of the catalysts. We'll talk about Iran and everything after that. But a big portion of the move down this morning was producer inflation numbers. And we weren't really expecting to have such hot numbers, but they came in as such. Month over month, 0.7 versus 0.3. That was really, really not good, right? 2x year over year, 3.4%. Month over month in terms of core, excluding food and energy, which have been very volatile, 0.5, and even core year over year, 3.9. This producer inflation report was pretty much a disaster. And I don't use that word lightly overall, but I will remind you, when I go through the reasons why they accelerated here, just keep in mind, right? The price of the barrel of oil didn't only start going up after the conflict actually began. As a matter of fact, you started to see a rally here. You'll notice the price of the barrel of oil, which was helping inflation to the downside on the producer side and the consumption side too, right? It was down either in December and our analysis throughout the month of January. It's really through the month of February that it started picking up from about the mid $50 regime per barrel all the way up to the mid 60s. And that's a pretty decent increase. Keep in mind, this producer inflation metric is for the month of February. We don't even have the actual numbers for the month of March just yet. We'll have to wait for that. But suffice to say, the month of March is probably going to be the worst month, arguably, this entire year for year over year or month over month gains in terms of CPI numbers perhaps, and also producer numbers too. So what's the full breakdown here? Well, it was a rise in final demand goods, plus 1.1% month over month, the biggest jump since August of 2023. Food prices, a massive 49% jump in fresh and dry vegetables. Energy-related items, diesel fuel was up 14%, and also chicken, eggs, gasoline, jet fuel, and tobacco products were also higher. The Iran war has amplified oil and supply chain pressures, helping push goods inflation a little bit higher. But we know the impacts of the war were not really felt until the beginning of March, where there was a buildup leading into that. A lot of people ordering inventory before. Final demand services. This was also problematic. And this doesn't really have much to do, at least back in February, with the price of the barrel of oil. But towards the end of the month is when that really started increasing here. 0.5% month over month. Traveler accommodation, hotel and motel rooms, 5.7%. That was your largest contributor. Transportation and warehousing services, 0.5%. And now trade services, either wholesaler or retail margins, plus 0.4%, indicating a partial pass-through of tariffs. So much of this stuff, whether it's warehousing or trade services, was the continuous and lasting impact of tariffs, which are to be felt right now, but also a bit of a preemptive rally because of the rising prices of energy into the end of the month of February. So keep that in mind. Not a very good print. So then we look to Jerome Powell and his statements today and the Fed statements to see, does the Fed have more clarity? Are they able to look through these supposed one-time increases in inflation, and can they give us a little bit of guidance pertaining to that? So here are the releases from the Federal Summary of Economic Projections, something they release once every single quarter. You can see here that in terms of changes in GDP, the Fed is still quite bullish here for 2026, increasing their projections from 2.3 in December to 2.4 for 2026. 2027, they went from 2 to 2.3. 2028, they went from 1.9 to 2.1. Unemployment rate stayed firm at 4.4. That was the December projections. We got 4.4 again, and you can see longer dated 2027, 2028, they do not deem there to be a structural unemployment problem that will be increasing over time, right? These are 19 Fed members that commented on this. The big increases here come in terms of the ways of inflation. So PCE inflation, December print, they had projected 2.4% for 2026, now 2.7. However, it will not be lasting, per their analysis, into 2027 nor 2028. And core PCE, same concept, from 2.5 to 2.7. So this is the worst part of this entire summary of economic projections. But it was to be expected with tariffs persisting, and also now the war impacts, right? And the Fed has had time to price all these things in. Now, another negative thing is the direction of the interest rates. 3.1 to 3.6% is the range. This pencils in one interest rate cut for 2026, and in 2027, one more interest rate cut too. Those are the Fed's projections, and the market has reacted consequentially. You can see here that the probabilities for the rate cuts into 2026 really only favor at most one rate cut, if any, for 2026, and then one rate cut for 2027. The market doesn't like that. The market wanted to price in 2 to 3 interest rate cuts for this year and 1 to 2 interest rate cuts for next year. That has been revised down by both the Fed and now market probabilities. That's not good. The main takeaway from the summary of economic projections is exactly what I've been telling you guys for the better part of the past 2 months. The fact that it's very tough to be bearish on the markets in the long term. There will be bearish narratives at play in the short term, as we clearly know and we've been describing, but it's very tough. And you remember I read you that note from Goldman Sachs just a few days ago, and they were echoing the same things, right? It's tough to be bearish on the market for the medium to long term. Short term, we have everything in the kitchen sink in terms of the short-term bearish narratives, whether it's the Iran situation, the private credit situation, the soft current jobs data, the new Fed chair being potentially hawkish, the issues with the AI paradox and the SaaS apocalypse sell-off, the continuation of the yen carry trade unwind, everything in the kitchen sink currently. However, long-term, strong GDP, rate-cutting environment still, but now revised down. So this is less of a bullish tailwind than it was perhaps 2 months ago. Still low unemployment. Fed's projections, right? Not mine. Lowish inflation as well. As we can see, lowish inflation for longer-term bullish tailwinds increase temporarily throughout 2026, but then tapering off, right? And thereafter, we further continue into strong earnings from Q4. We also did have very strong earnings all across the board. Price action was garbage, but the earnings, the bulk of it was very strong. You still do have the AI megatrend and all the infrastructure build. And then you also have the massive, big, beautiful bill, $4 trillion in tax cuts, and a lot of deregulation. So, moral of the story, it is very tough to be bearish on the medium to long term of the markets with these GDP projections, these unemployment rate projections, and these medium to longer term inflation projections, right? However, it does leave the Fed in a bit of between a rock and a hard place now in terms of interest rate cuts, right? So short term, volatile, will be very volatile. Short term, culmination of bearish narratives. Medium to long term, decent, which is what I've been saying, guys. If we're trading the markets, we have to be very nimble and use days like yesterday to take a lot of buying power off the table and avoid volatility events, and then possibly put the capital back on if we are trading during the volatility events, especially if we are selling options, which is what I've been personally doing, right? It's not the time to get greedy in the short term. It's not the time to necessarily be a hero in the short term as well, calling big swings in direction either way, because the markets are super volatile right now. However, if we are a long-term investor, should we still be investing or holding cash? We should largely still be investing because the long-term picture still looks pretty good. Now let's move into some comments by Jerome Powell himself. And as I said, when I presented the moves on the S&P over the course of the day today, why did the markets come down? It was not because of that summary of economic projections. That was released at 2 p.m. You can see until the moment where Jerome Powell started speaking, which is 2:30, the markets actually absorbed the summary of economic projections and saw it to be quite dovish in terms of their projections, right? Very bullish projections in terms of the economy for the medium to long term. However, when Jerome started talking, the markets completely unraveled all the way through the close. However, if you listen back to the Fed meeting, you will listen to the fact that Jerome Powell was very nice to us. He tried to be as nice as possible, answering questions to the best of his ability, but also the tone was very responsive and very accommodating. However, it's not what he did say, it's what he didn't say. Too much uncertainty. The Fed is almost flying blind right now. So amid stagflation fears. A lot of people have been saying stagflation. Jerome Powell and the Fed members, they don't think so. I also have to point out that that was a 1970s term at a time when unemployment was in double-digit figures and inflation was really high. I mean, much higher than it is today, guys, right? Right now, it's what, 2.5%, 3%? Yeah, back then it was over 10, right? Plus double-digit unemployment. We actually have unemployment really close to the longer run rate of normal, and we have inflation that's 1 percentage point above that. He's not wrong. I would reserve the term stagflation for a much more serious set of circumstances. And we've been saying that on the channel as well. You remember a couple months ago in like October, he said, I don't see the stag and I don't see the inflation. Same thing, right? Doesn't mean that it can't possibly happen, but that's a little bit of an overstatement right now. Powell says we're in a difficult situation. We are balancing these two goals, meaning full employment and low inflation, in a situation where the risks to the labor market are to the downside, which could call for lower rates, but the risks to inflation are to the upside, which would call for higher rates or not cutting anyways. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like we are now in just kind of on that borderline, the higher borderline of restrictive versus non-restrictive. Notice, not a very certain statement, right? The Fed is continuously waiting for more data to possibly derive what is the right thing to do, but they do not have all the answers right now. And he builds upon this a little bit further. Oil price shocks could be offset by higher energy production, says Jerome Powell. The net of the oil shock will still be some downward pressure on spending. Obviously, higher gas prices, higher possible transportation services prices, people will spend less to save their dollars, right? So, although the prices of energy are going to be moving higher, it may eventually crush some of the demand side of consumption, right? So, a bit of polar opposite effects working in terms of inflation right now. But he added that these shocks could be offset by higher energy production in the US. We know that the US is a very big producer of oil currently, and also a net exporter of oil. So, the impacts in terms of inflation could probably be felt more a lot in Europe and in Asia, but the United States may be more muted. Not that there won't be any, but they may be a bit more muted than elsewhere. Keep that in mind. We are a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable and they may even do more drilling. Moving on further here, no one knows what the impacts of the war will be. More uncertainty. Powell said there's uncertainty tied to oil prices amid the US-Iran war. The US economy is doing pretty well, however, he said, but we don't know what the effects of this will be. Really, no one does. Once again, more uncertainty, right? Inflation isn't coming down as quickly as hoped. The forecast is that we will be making progress on inflation, not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs going through once and then tariff inflation coming down. The rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut. Talking about progress on inflation. He spent a lot of time talking about the lingering impacts of tariffs. And Jerome Powell actually spoke about something today that I've been telling you guys as well many times on the channel. We are still today feeling the lingering impacts of COVID. Yes, even 6 years later. All of this started with COVID. The inflation problems, the supply chain problems, the sticky prices in the economy right now, which is pinching consumers. All of this started 5-6 years ago, and you're still seeing the ramifications of that today. Now, previously, they were quoted in saying that if it weren't for tariffs, they would have already cut interest rates by now, and inflation probably wouldn't be as sticky. This is true. If it weren't for the current war between Iran and the United States and Israel right now, well, additionally, you wouldn't see these possible resurgences in inflation so far. However, you wouldn't have these inflation problems to begin with if it wasn't for COVID and the massive amounts of money printing, right? So the reason the markets dropped, even though Jerome Powell had some pretty good commentary for us, is because he didn't drive home any certainty. He, such as many of us, are just waiting to see what happens, and they do not want to predict or speculate what the outcomes will be or how long they'll last. However, still reiterating that they would have the tools to possibly counter anything that does happen. That is your recap with Jerome Powell. So unfortunately, not much insight from the Fed in the short term. And that's the problem that the markets had with today's Fed release, right? The summer of economic projections are good for later in 2026, meaning second half, and then 2027 and 2028. But from now until the midpoint of the summer, more uncertainty ahead, and that's not exactly what the market necessarily wanted to hear, but is something that the market will continuously have to face. That's everything for that. Now, moving on to more news headlines. What happened today in terms of the war in the Middle East? Well, very early this morning, at least Eastern Standard Time, Israel went in and struck Iran's gas fields. that was to be avoided almost at all costs, especially when you do not have control of the Strait of Hormuz, especially when you're currently going through a bit of an oil and an LNG crisis. So now, in response, Iran on its own has targeted not only Saudi Arabia, but also Qatar, right? So the largest LNG hub in Ras Laffan in Qatar has been hit by missiles. Qatar Energy has confirmed extensive damage and fires at the facility that provides 20% of the world's natural gas. The attack comes just hours after an Israeli strike on Iran's South Pars field, with Tehran officially declaring Gulf energy centers legitimate targets and ordering immediate evacuations of all personnel. Iran posted on Twitter screenshots of all of the oil installations across many allied nations in the Middle East. Countries such as Israel, Oman, Qatar, Saudi Arabia, the UAE, they literally posted satellite screenshots of all of them and say, yeah, you guys should probably evacuate because we're about to do a big retaliation. This is the largest escalation that we've seen, at least over the past week and a half. It seemed as though tensions were cooling down a little bit, right? But now with today, definitely re-accelerating yesterday and today largely. And you can even see that in the amount of drones and ballistic missiles that have been launched. Ballistic missile count, it was coming down almost through last week. It was down 90%, more than 90% from the top. Look at yesterday and today, right? Increasing back again. That's not good. Out of Iran as well, drone swarms coming clearly down from the top right here. And then, well, a few days ago, they started re-accelerating, but especially yesterday and today, they're back up. And especially today, they're back up almost to some of the numbers that we saw at the very beginning of the conflict. So although the United States has destroyed a lot of Iran's infrastructure right now, they are still resourceful in their ability to launch drones and ballistic missiles from mobile sites. So keep that in mind as well. This is obviously not what you want to see. And the rhetoric escalation, because their oil fields or their gas fields were struck, also an unfortunate escalation. That was the big piece of news today. And as a result, the oil markets responded because of this escalation. Now your futures prices are getting a lot more tight together. You remember when I first showed you guys this chart 2 weeks ago, and I said, closely monitor the evolution of how tight this pricing gets throughout the rest of 2026. There was a clear drop-off from $90, $100 where we were about a week and a half ago when this whole conflict started, right? They were at $100 up front and then mid-90s for May. And then by August and September, you remember, it was in the 70s, right? Now, look what happened, right? They've increased the price of futures, saying that even though the conflict will be resolved, there's a lot of damage that's been done to supply chains and a lot of damage that's been done to the energy infrastructure across many allied nations in the Middle East. And as a result, your oil prices, even if the conflict resolves itself tomorrow, may still remain sticky lower down on the curve all the way through this fall. Keep that in mind. Moving on further here. What's funny about this entire situation is that obviously short positions on, well, not obviously, but curiously, short positions on U.S. oil funds are surging. Short interest on the ETF IEO is up to 2.8%, near the highest in 4 years. Short interest has tripled since the start of 2026. So people are trying their best at shorting oil and oil companies close to the top. Now, this short interest is not high by any metric, especially when you compare it to individual stocks that can have like 15, 20, 40% short interest, right? But the highest still in 4 years. So there is some downward pressure on the price from that. We will see. This is going to create excess volatility. It does not mean that we're going to drop from here. All it's going to mean is that the moves, as we come into these very high levels, will get very volatile, as now you're starting to get heavy positioning on both sides. Moving in a little bit further here, changing gears, a little bit more lighthearted news. Meta coming out and saying they're announcing that they're going to be shutting down the metaverse after pouring $80 billion into the project. This is going to be shut down in the month of June. To many Meta investors, such as myself, this is very welcome news. You want to know why? They've just put way too much money into it, and it's going to free up a lot of operating cash flow as well. Look at the losses every quarter. These are quarterly numbers, not yearly. Every quarter, guys, $5 billion. So beyond June, expect Meta to have $4 to $5 billion more in operating income, which is going to help bolster operating margins, net margins, and consequentially EPS. So we could possibly see a re-rating of Meta's EPS to the upside, which would mean that at current share prices, the company is trading for even cheaper than we currently estimate. Right now, where it is at about $620, we're trading at 18 times forward earnings. If you give us a little bit of a 10% EPS jump over above that, or maybe 15%, over and above the estimates because we're freeing up so much operating cash flows right here, which will translate into bottom line net margins and earnings per share. Well, we can see a nice little uptick. So something definitely to look forward to if you are a Meta shareholder, because we know the price action has been absolutely terrible, but effectively the company, not only because it's down today, but after this piece of news, the company just got effectively cheaper to own because they just won't be burning that $4 or $5 billion in operating cash towards their metaverse endeavors every single quarter. Moving on a little bit further here. Oh, sorry, I spoiled the punch. That's it for our news cycle. Hopefully you enjoyed. Still the market environment right now to be very nimble. And coming into today, guys, we had a plan, right? Of freeing up some buying power. Late last week, we started freeing up some buying power. And even this week, I was saying go slow on Monday and Tuesday and make sure you clean up a lot of your trades into the Wednesday session because it will be volatile. I did that myself. Our Discord group did so as well. So we were able to embark into today's price action, right? Even though some of the long positions were down, most of our buying power is still in our back pocket. So hopefully you guys as well were able to remove some positioning prior to these events with the S&P and the Qs being at very critical levels and with tensions being very high leading into this, leading into Jerome Powell's FOMC statements and summary of economic projections, right? So for the long term, we can still be bullish on these markets, but in the short term, we know it's going to be very, very volatile and a push and pull between the headlines, as it has been the case over the past 2 months, let's call it. All started with Claude and SAS and all that good stuff. I mean, it all started with first Mag 7 and CapEx. And is there going to be any efficiency or cash flows from all of this? Number two, went into the SaaS apocalypse with Claude bots and Claude agents with the big pivot to agentic AI and inference. And now we get Iran and that entire situation, right? So it's been quite, and throw it all on top, you know, throw it into the salad, right? Private credit risks as well, right? So constant barrage of headlines right now, which just reiterates the fact that we've been saying, right? It is an everything in the kitchen sink market right now. All of the bearish narratives are firing at the exact same time, which is why it's been so choppy and why the S&P has cleanly rolled over here, at least in the better part of the past 2 weeks, after being relatively resilient, even all through those initial narratives. The Iran situation was just the quote unquote straw that broke the camel's back. Not trying to make a pun because we talk a lot about the Middle East, but anyways, it's the closest thing that I can come to. Not to make fun of the situation, but you know. All right, so moving on into next part of the video, which will be good old Micron earnings. And Micron, guys, I mean, number one, they were already up from the lows of just about a week ago, 2 Mondays ago, right? They were already up 30%, so you can't ask too much from them. But they absolutely destroyed, and I mean destroyed, this current earnings. I don't think anybody had any doubts about that, but the increases in guidance were quite frankly ridiculous and some of the best earnings that I've ever seen. And that's after covering SanDisk's earnings last quarter, which are equally as breathtaking. Micron coming and taking the cake right now. EPS beat by 33%. That's not easy to do. And revenue beat by 20% as well. So how come the stock is down right now? We're going to talk about it, and it also has to tie into gold, right? These assets that have been running super hard into today. Today we got an escalation. We got uncertainty from the Fed, and we got escalation in the Middle East. So now everything, even themes that have been moving very well, are up for profit taking, right? When things start hitting the fan, and you start seeing people race for the exits, even in trades that are supposed to be resilient to all these conflicts, because number one, either they have huge demand for their products, which we'll talk about, or that they're supposed to be a safe haven asset and they don't hold up. It just goes to show you that you might be embarking into the last leg of a possible capitulation or liquidation flush. I'm not saying for sure, but when you start to see these signs mount, right? We're already in oversold territory. Breadth is oversold. Whenever you get oversold, right? There can be that last big liquidation flush, similar to the Liberation Day last time, right? We're not saying the market's going to fall, 10% in 2 days here, but you may be coming into a similar situation where it builds and builds and builds and builds. The pressure builds, and then you get one or two catalysts like today, and it sends you for the final liquidation flush, the capitulation flush that we've been kind of referencing on the channel as well. But getting back to Micron's earnings, the earnings themselves were absolutely ridiculous. Take a look at this, guys, right? Not only they beat on our EPS and revenue by that much, but look at the numbers. EPS was up almost 7%. 700% year over year. Revenue was up 200% year over year. And just look at the quarter over quarter gains. Ridiculous numbers by Micron. Moving on a little bit further here, look at their margins. Because of all this increase in revenue, increase in RAM prices, gross margins 75% versus 69% expected. Beat it by 5%. 6% almost. Ridiculous. Operating margins 69% versus 62% expected. And this company put up 57% net margins for Q4. These are some of the best margins in the company's history. In the company's absolute history. Look at this margin expansion right here. Micron in Q3 of 2024 had 27% gross margins, 10% operating, and 5% net. What they just gave you today is levels and multiples all the way above that, right? What they gave you today was an absolute blowout on gross, operating margins, and net margins alike. Additionally, the guidance was straight ridiculous too. Adjusted EPS, 19.15 versus the 11.7 estimate. Guys, that is the most ridiculous EPS beat that you'll possibly ever see in your career in the markets. That's a 64% raise in guidance for next quarter only. Revenue, look at this. The estimate was $22.5 billion. They put in $33.5. They beat their estimates, which were already raised estimates, by $10 billion. That's a 50% almost beat on revenue guidance. Yet still the stock comes down. So this is not a question of Wall Street wanted perhaps more, or maybe even the stock ran a bit more. No. Possibly profit taking all across the board. Adjusted gross margins, even more. Currently came in at 75. Next quarter, it's going to be 81, which is absolutely ridiculous, in my humble opinion, guys. They did raise CapEx guidance to $25 billion, which was a slight raise as well for the entire, for the whole fiscal year, because now they're into Q3. So that being said, they raised their CapEx a little bit there. But overall, guys, the earnings numbers were substantial. Moving on further here, look at this operating profit. Complete blowout. So here, this chart references from all the way back in 2015, and you can see the various cycles of memory. But the reason why many people, and myself included, say that this time is different is because they're ramping a much more profitable segment of memory. All these times before, guys, this had nothing to do really with data centers, okay? This was all, automotive and industrial applications and computers and smartphones and tablets, right? Those things are cyclical for sure. What we're seeing right now is a cycle that can last into 2028, 2029, 2030. The chief technology officer of SK Hynix said as much at the NVIDIA GTC conference just a few days ago when he said he sees demand shortages through 2030 for memory in relation to everything that goes into a possible data center. So keep that in mind, guys. That is why it may not be so cyclical this time around, because you've added new products that have tremendously high margins that are just incredibly in demand in one of the largest infrastructure buildouts of all time. So that's some of the cyclicality argument, right? How it just dwarfs. Look at the operating profit. You can clearly tell the cycles before, right? This time, not so much, still ramping, right? It may be beyond 2028, 2029, 2030, but the goal of this analysis is to determine, are these stocks done? Is there still meat left on this trade? And the answer may very well be still yes. Moving on further here, Micron business segments. Look at this. Cloud memory, 74% margins. Mobile and client, 79% margins. Core data center, 74% margins. And automotive and embedded, 68% margins. The margins are going up all across the board. And that's very important here, guys, as well. Additionally, at the same time, look at the explosive scale of the breakout quarter, right? Fiscal FQ2 2025, fiscal quarter 1 2026, and now Q2, right? Look at these increases in margins. Additionally, 30% dividend increase by the board. They have bought back some shares, but look at these increases in margins. I showed you before, but just as a visual representation, massive. Moving on a little bit further here, this is your Micron market share of the current HBM landscape. So you can see Micron is a very big player, but SK Hynix, an even bigger player, and Samsung as well. This is why I say we keep paying attention to SanDisk, okay, for different forms of memory, obviously, but SanDisk, you can talk about WDC as well, but the market leaders, SanDisk, Micron, and EWI for that juicy SK Hynix and Samsung exposure. Those are your large top tier players in HBM, which is largely used for data centers right now. Further comments this time by management. So number one, net income was $13.8 billion. We already referenced it. I referenced it on the chart. 50+% margins. And these are some of the best margins in Micron's company history. That is absolutely ridiculous amounts of net margins. Moving on further, comments from management. As AI evolves, we expect compute architectures, I don't know why I said it like that, compute architectures to become more memory intensive. This is why we strongly believe that Micron is one of the biggest beneficiaries and enablers of AI. The CEO said on the earnings call that volume production of HBM4 for NVIDIA's Vera Rubin started in the fiscal first quarter, and next generation HBM4E products will ramp into 2027. NVIDIA has said it will utilize custom HBM in its next generation Feynman GPU coming in 2028. The CEO added that capital expenditures will step up meaningfully in fiscal 2027, with construction-related costs increasing by over $10 billion, but they're definitely good for the free cash flow right now. Micron is building 2 giant new campuses of fabrication plants in Idaho and New York to increase its memory manufacturing capacity in the US. He also said on the call that the initial production at the Idaho site is expected by mid-2027. Micron broke ground in January on the massive $100 billion New York campus and expects wafer output by the second half of 2028. They're all scrambling to increase production. Micron has been building these factories now for the past 2 years. We've covered them on the channel for the past 2 years. These are going to be extremely large. SK Hynix and Samsung are also building factories too. However, it takes a very long time to build a memory factory and a wafer factory at the same time, right? It takes about 2 years from the moment of time you put the shovel in the ground to when you start actually getting into production. Micron effectively across the board is sold out for 2026 and will still face large demand constraints through a majority of 2027. Moving on here further, a couple little highlights. It's not only data centers, guys. PCs, we know that AI-enabled PCs will require more RAM. This time, however, in 2026, they do expect PC and smartphone units to decline slightly in the low double digits percentage range. All of their firepower is currently going to data center and AI, but expect further increases. The moral of the story is that can't count these down and out. These are the more cyclical aspects of the business. However, they're still hitting record numbers. Mobile, the mix of flagship smartphones shipping with 12 gigabytes of RAM or more increased to nearly 80% in calendar Q4, up from under 20% a year ago. This will persist as more and more smartphone manufacturers will be using AI, especially on-device AI. So the mobile and PC segments, despite being some of the more cyclical aspects of the business, still are into big inflection points for the next few years. Automotive, industrial, and embedded. This is very important. The average car today has less than L2 ADAS capability, which is advanced driver assistance systems, right? Less than level 2, containing approximately 16 gigabytes of RAM. More robo-taxis, more RAM. Vehicles with L4 autonomy require 300 gigabytes. Something to look forward to. If we're talking about Micron, this is once again is the company that's cyclical. And how long will this next cycle last? PCs and smartphones have been soft for the past 2-3 years. We're about to embark into a big movement for Micron because of AI. They will need more RAM. Automotive as well, it will need more RAM because of all of these self-driving cars. A little bit further here, don't forget about these guys, right? The right hand of the screen right there. The robots. Nobody's thinking about the robots. We believe we're on the cusp of a 20-year growth vector in robotics. Sorry about that. And they expect to become one of the largest product categories in the technology world. What do you think that's going to do as well for the cyclicality of Micron? So we are possibly witnessing right now with this AI infrastructure build out and movements towards robotics, right? Several different ways of doing that, robo-taxis, but also various different forms of robots. You're possibly witnessing a company that previously was locked into PCs, mobile, and some industrial and automotive applications to now having tons of automotive and tons of industrial applications, mobile and PCs, which will be using more and more AI. And of course, we didn't even talk about the data centers. Well, we did before, but just to show you, right? So is it really that cyclical anymore? That's the big question. And hopefully at the end of this, you can conclude that maybe it's not as cyclical as it once was. DRAM numbers, revenue 207% increase year over year. That's just ridiculous, right? And NAND 169% year over year. So absolutely ridiculous numbers by Micron. You'd be hard pressed to find better earnings than this in the market landscape right now. Absolutely ridiculous. The last time I saw an earnings as ridiculous as this, I mean, you can talk about SanDisk's earnings last quarter. We can also talk about Palantir's earnings last quarter. But these types of earnings beats, these massive crushes and massive guidance raises, you do not see them all the time. It means the company is definitely into a structural shift right now. And as a result, is memory just going to fall off a cliff in 2027? Probably not, because they have more than one growth driver ahead of them. As we viewed smartphones, PCs, robotics, industrial different applications, whether those are production facility robotics like supply, production line robotics, or humanoid robotics, or various different robots that you can use in factories or either consumer facing, and also, just talking about the entire facets of their various businesses here. I think I'm forgetting one, which is, no, I think I covered it, right? Cars, robots, mobile, PCs that'll be wanting more, and obviously data centers too. So at the end of the day, guys, is Micron cheap or is Micron expensive? I'm pretty sure you guys are all wondering. Just get to the point. Do I buy this stock now or what, right? Super tough, guys. To project these numbers, it's very tough. So I'll just be front and center in saying, I'm going to have to wait largely to redo this valuation. I mean, I redid it a little bit, but there's several assumptions we have to make, right? We don't have projections for Q4 ending EPS, right? They just blew Q3 out of the water. I don't have Q4 just yet for EPS. I also don't have Q4 for sales. So I've taken into consideration the new Q3 numbers, but not Q4, and any adjustments that Wall Street chooses to make, the analyst consensus numbers for 2027 as well. That will probably happen over the course of the day tomorrow. Tomorrow, you'll get to see all the analyst price target increases in EPS, increase in revenue projections, right? So I'm working with like half of the information right now. I'm almost flying as blind as Jerome Powell, but not quite, right? So we know margins are ridiculously high right now. Revenue and EPS growth rates, 55% revenue growth rate, on an average, 60% per year for the next couple of years. The only problem here is that, look, okay, you can call this cyclical, but I mean, we're not going back down here, right? So 2027, super high. 2028, they say it's going to be lower than 2027. We'll see into the next few days if these are revised. That's why it's tough to derive some form of an average from here. So I'll wait for that information. And the same thing on revenue. They say there's going to be a decline in revenue 2028 and 2029. I will wait and see if these projections get revised. So instead of taking net growth rates and driving a peg, just in terms of forward numbers, right? Can we make some money on this stock? Well, moving forward here, price to earnings at 450 for next year or for the end of 2026 for them, it's a 9, which is, and I'm not even going to do a peg ratio. You guys can divide 9 by 60 if you want. It's ridiculously cheap, right? Price to sales, 5.83 with phenomenal margin profile overall. So very cheap still. And once again, people say, yeah, but it's cheap, but this is all very cyclical, right? Well, I mean, are we going to lose? Like, how much revenue is this company going to be making, right? It's a $500 billion company. They're making almost $100 billion this year, next year, over $100 billion, and for the next few years, $100 billion as well. Are they going to trade at 5 times sales for the next 4 years? Will all their divisions keep printing money? Arguably not, right? So I still do believe that there is some upside on Micron, SanDisk, and also EWI, which is a combination of SK Hynix and Samsung, and they should be front and center on your radar as per buying dips. Just be careful. It's tough to size in up here without much of a pullback, right? If you get a pullback here, watch for the 12 EMA. Micron, SanDisk, all the other memory names, they've respected this 12 EMA in a substantial fashion. It might get a little bit spicy in the overall markets right now because of what the broad market indexes are doing, but these are definitely names that will probably have still a lot of upside here into the next, not talking about the next week or next month or next quarter. No. The next like 2-3 years. Is there still a decent risk to reward trade to be had from here? Indeed, I believe there is. Notice I don't say there's no risk whatsoever, right? Of course there's risk as with anything, but is the risk reward skew still positive? Can Micron still pull off a 2x from here while the numbers would still make some form of a logical sense? Yes, it can, and so can possibly SanDisk and also Samsung and SK Hynix with their massive operating profits. It's just that we need a bit more visibility, a bit more projections here. I'll refine these numbers later on in the week. Thank you very much for paying attention to these earnings. That's all I had for you for good old Micron. Now, let's move into some of the indexes, shall we? All right, so working our way into the good old S&P 500. We are at a crucial line in the sand level right now. Equal lows right here at about 660, right? The futures market right now is green. The bulls need to mount some pretty good defense here around the 200-day EMA. If you flush through it, guys, you are looking at all the recipes, all the ingredients right now for the quote-unquote capitulation and liquidation flush. You have all the recipes, all the ingredients for it. We've been building slowly into it. We were kind of hope for the best, expect the worst in this current market environment, right? Hoping for a bit of an easing of the tensions here over the course of the past few days. Tensions escalated. As a result, the markets responded in tandem. No clarity from the Fed. As a result, now you have a kitchen sink situation where you have everything being thrown at you. So not the current market environment for any swing trade longs at the current time until the price action improves. We need to wait for a new daily uptrend if we want to be able to position in swing trade longs across many growth names, across many large cap names as well. The price action is not conducive to that. If we are trading in the markets right now, we wait for these liquidation breaks, high VIX environments right now, and weak market breadth to fire off some short puts under the market. It's the probably only trade that I'm going to be doing over the foreseeable future until price action improves is wait for the big red days, wait for the volatility spikes with the VIX, and sell put options way below the market structure to generate some income. Conversely, we can also position for some longer term positions. We know that a lot of companies are trading excessively cheap right now, so DCAing with our paychecks, still a very good element to the markets right now. Market breadth is incredibly weak. You can see right here, the market breadth was improving over the past 2 days, relief rally bounce, as I was saying, and now we are currently heading a little bit lower. In this current market environment where breadth is so weak, should we be buying or panicking? If we're long-term investors, we should probably be buying with our DCAs, with our paychecks, right? However, if we are short-term trading, not the current market environment to be a hero right now. Moving on to the percentage of stocks above their 50-day EMA, same concept, right? Very weak market breadth. Usually when they're in the context of this, I can go back 20 years. No matter what the market environment is, a good environment to go shopping, yes, but slowly and very tactically. Okay, percentage of stocks above their 200-day EMA actually finally starting to break down. We're now coming into some of the last April levels of the market, right? So if you currently see more and more market collapse and a lack of rotation, because previously we were seeing some rotation. Now you're not seeing any rotation at all. They're selling off the Micron earnings. They're selling off gold, silver as well. They're selling off the metals, right? Basically everything is fair game to be sold off. They sold off the recent Bitcoin rally as well. It's an everything sell off right now, right? So the bulls have to play some pretty good defense into tomorrow. Key area of structure. If you do break down, guys, once again, you're heading to this 12 EMA, which is about 650, lower end of support, and we will take it from there. Moving on to the QQQs right now, same concept. The Qs dangerously close to breaking support. A lot of momentum after a day like today. They got to save this one. 590. Right below that, you got the 200-day EMA. On the futures market, you're very close to it as well. So keep that in mind. Daily still showing signs of weakness. The weekly downtrend is largely underway still at the current time. And you will be looking for, if you do break down 580, 12 EMA backtest, that would be almost a 10% sell-off from the highs into market correction territory. The longer term time frames, right? Don't take it from me, take it from the Fed, right? Longer term, it's very tough to be bearish on the markets right now, but short-term consolidation and corrections are definitely on the table. So if we are trading, right, very tough to take directional trades. It's been a perfect environment to throw on some hedges, and we talked about hedging capabilities with put debit spreads because buying outright puts are quite expensive. So put debit spreads as hedges to the downside, benefiting from the high VIX to write covered calls on our positions. And if we're trading, selling put options, waiting for the big red days, not chasing on green days, but waiting for the big red days, selling puts on the market, very decent proposition in my humble opinion. That is how we are supposed to stay nimble in this current market environment. Moving on to XLF financials right now, not having it, right? So financials across the board getting decimated today. Visa down a ton, MasterCard down a ton. And the logic for them is very simple, right? A lot of these credit card players or even the buy now, pay later players, right? No news specifically to them today, but what did happen today, right, is with the current conflicts and whatnot, the increase in the price of the barrel of oil, the algorithms are very simple, okay? They don't think too much further into it. And all that they see is rise in the price of energy, rise in potential inflation in the short term, impacts on consumer pricing power, and as a result, these companies may see lower volumes, right? And for the banks, it's the same concept, right? Keep interest rates higher for longer. Unfortunately, these banks will not be able to make as much money on net interest income as they may have done if we were pricing in 2 to 3 interest rate cuts this year. And on top of all that, you throw in the whole private credit situation, and once again, financials are in an everything in the kitchen sink situation. So daily downtrend persists right now. Lower end of the range, we're coming again close into daily oversold conditions, not quite weekly oversold conditions, but one more little vault down into here, right? Into the 46 to 48 to 46 range. You might even get weekly oversold conditions. That rarely ever happens. At this point in time, financials are down 12. If they start to come down 15, 16, that's going to be an extremely juicy proposition to continuously build some of the financials positions, but very tough market to swing trade any longs in financials right now. If anything, short puts are my favorite way of playing this, or building longer term positions only. Moving on to good old healthcare right now. So healthcare down 1.67%, and it's coming down into a key area of structure, but with too much momentum for my liking, right? So big daily downtrend, rejection from the resistance range, 153 to 151, and now coming down hot, breaching the 200-day EMA as if it was not even there, and also into oversold conditions. So be careful on this one. I was saying I was interested in this. If it pulls back into here, yes, but you got to slow down a little bit, right? It's not, this is just too fast, too much momentum, too quickly. As a result, I'm not going to be participating in any healthcare swing trade longs until we can find either some support right? Or better price action in terms of a daily uptrend. Until that time, I'd rather just sit on the sidelines and wait. I will be very interested though, because we're still waiting for this monthly higher low. It's just you got to slow down the price action for me a little bit if you want to see me try and nibble and try to take some swing trades long. So healthcare definitely on the watch list now, as opposed to over here where I wasn't really interested at all. Now I'm interested, but I got to wait for better price action. Moving on to SMH right now. SMH down about 0.81%. And in spite of all of NVIDIA's releases recently, and Micron earnings, semiconductors still suffering. So daily downtrend, nice engulfing move, higher low, lower high. Tomorrow, if you unwind, guys, daily downtrend resumes, coming down here, 376 to 368. Weekly will also be unwinding. You are possibly looking for some lower highs and just further weekly consolidation. And that, if the markets do give you the capitulation liquidation event, I'm not saying it's going to come. I'm saying if it comes, we may get the most fantastic entry that we've been waiting for a very long time in the indexes, which is a pullback to this 12 EMA 345. That'll be a nice pullback, guys. It's a long way down. A lot of names would probably have to suffer, but are there names that can possibly come down a little bit more? Sure, of course there are. The memory names can come down off their 30% pop into Micron's earnings, right? ASML, LRCX, right? LRCX, some of the other ones that have been ridiculously high recently, AMAT, they all have room to fall. TSM has room to fall as well. So keep that in mind. It's not as if there's no room to fall on these, and it's not as if we're bearish on these. It just means that's your market bull. And if you start losing structure, even on your market bull, it's going to accelerate the move to the downside. And that's how you get kind of a culmination of just total market breadth collapse, liquidation flushes, capitulation flushes. It doesn't mean we should be fearful. It just means we should understand how it's coming. And if it can possibly come, which the answer is yes, and position accordingly, right? So be very slow on your trades, right? And you know that there's a key way to trade this market right now. Selling options premium, arguably much better than playing things directionally, unless you guys want to play. If you guys are playing downside, put debit spreads are going to be your best friend, because right now you're paying a lot just for only ordinary put options, like long put options, I mean. So put debit spreads. If you're trying to play downside, use the put debit spreads, limit the impacts of volatility overall. They'll be your best friend in this market environment. And IWM Russell, unfortunately, also showing signs of wanting to break down a little bit further. So we knew they were in the context of a daily downtrend. Lower high, as we were saying yesterday, right? The balance was quite soft and not out of resistance under the EMAs. Break down a little bit lower. This one too will be challenging its 200-day EMA. Next stop, 240 down about 237. That'll be a nice pullback of about 11% from the highs, but right, still going to challenge our 12 EMA. We will see how the price action reacts from there. As of right now, the bears in full short-term control. That's the moral of the story, right? The bears are in short-term control of everything right now. Of the SPY, almost the QQQs, definitely XLF, definitely XLV, starting on SMH, and even now the Russell, let alone some of the consumer-facing names. XLP, full bear control right now. Consumer retail, full short-term bear control. Utilities, still okay, but also that one showing signs of weakness. Real estate, also coming down. Interest rates been coming higher, right? Obviously. And energy also coming in some top effects, right? So the last thing you want to do is pivot everything into energy at the top right here, because even these energy names can even get sold off if you're going to get that big market breadth rotation down, right? So please keep that in mind. The VIX, 12% higher today. We were talking about this, right? Nice declines with the market action recently. If you spike back up higher, I'll definitely be paying attention. Tomorrow into Friday, guys, spikes on the VIX, it may offer up some ridiculous prices way below the market. So my top 5 options video that I did on Sunday, that was the entire moral of the story of that video, right? Was to wait for big red days, wait for volatility increases, and then go shopping at cutthroat prices on your favorite names, selling premiums far, far, far below the markets at prices that you would be very happy to be assigned and run the wheel on. So please keep that in mind. Moving on now to gold and silver. So gold breaking down below a key area of structure right now. I had to close my swing trade along on gold. That was always the premise. What we did today is there's a bit of a regime change here on price action. Can you see it? Well, if you said that's the first time that we've closed below the 50-day EMA, you would indeed be correct. And we were nervous about this coming into today's price action, right? This is the first time they've closed a daily candle. Not even after this big liquidation flush did we close a candle below the 50-day EMA. The last time was last August, and that was during a fairly soft phase of market consolidation, right? This monster second leg of the rally right here, right? This entire move, it's slightly changing right now. Below the 12 EMA at the same time, still 2 days until this gold market closes. However, I'm not in the trade to stick around to find out. Daily downtrend right now, heavy amounts of price action, not even close to daily oversold conditions, and closing below the 50 and being able to use this area now as resistance for a back test into a possible further flush. Yeah, maybe you just might head into the actual monthly consolidation phase. So to reclaim, or rather for me to be interested in a gold swing trade long again, as I said, if it breaks down here, I'm not going to be sticking around to find out if we actually go for the 12 EMA flush. No, if I want to find a swing trade on gold again, I will once again be waiting for a similar portion of price action like we saw here, going for the daily uptrend swings. You got to get the bulls back in control if you want to say, all right, this is a local bottom. If not, you are just guessing. And don't guess, guys. Hope is not a strategy. Wait for the price action to confirm some entries. Silver, same concept, right? Closing below the 50 EMAs and all the EMAs for the past 2 days, but silver has been much weaker than gold recently, ever since this liquidation flush. I kept saying, if you're trading silver, use gold as your lead kind of time frame keys, right? Or your lead player there. Because if gold goes down, silver is going to go down. It's just higher beta, right? Coming into support right now, 75 down to 70. However, cleanly below the 12 EMA on the weekly, right? This is your short-term momentum guide. They haven't closed a weekly candle below here since last May. If it does do it this time, not even during the liquidation breaks, okay? If it does it this time, it means something has changed. So pay attention to it. If you fall a little bit further here, guys, right? You're going for the infamous monthly consolidation. I'm still bullish on the metals through 2026 and beyond. However, everything, what goes up must come down. And eventually, when you find these nice entries to the 12 EMAs, that's when you can commit with a bit more size, right? If I'm taking little swing trades up here on gold, just looking for expansion with a stop loss, if I know that it's way up here, I can't put as much size behind it as if I know, great, I'm finally getting a monthly retracement, a decent monthly retracement to a long-standing moving average, cooling off the monthly RSI on everything, gold and silver, right? Then we get much better entries. We wait for the price action to resolve around those levels. You get your daily uptrend. Then I can put more size behind these trades and go for the longer swings because now we've consolidated in a big way. So keep that in mind, right? Price of the barrel of oil right now, under 100. You know, some short activity on it right now, but we'll see. Today's action, though, definitely higher, 3.16%. We will see if it accelerates a bit to the upside. One thing, though, okay, you got to pay attention to, guys, is this big resistance band. 110 down about $100 psychological. That was the peak in 2022. Most of the price action peak. So pay attention to that. With rising tensions and escalation, do you get another blow off top rally in the price of the barrel of oil, or will there be some forms of de-escalation into the coming days, which will prevent that? One thing's for sure is that oil is probably not going to come crashing back down to the 60s. If anything, even if we do get some form of a conflict resolution or military escorts through the Strait of Hormuz, you're probably just going to oscillate here around 80, you know, between maybe $90 and $80 for the foreseeable future. At least that's what these futures contracts are kind of extrapolating right now, with the price of the longer dated contracts getting tighter and tighter to our closer dated contracts as well. Keep that in mind. Bitcoin and Ethereum failing right now. So daily uptrend is still in motion right now. Higher lows are right here, 65.7. Let's be honest though. Do you really think that Bitcoin and Ethereum are going to go up if the indexes continuously fall under pressure? Probably not, right? So be very diligent with your stop losses. We've been talking about it. If you're in some swing trade longs from here, might as well put your stop loss at break even, because although you had a nice daily uptrend bounce and it could continue, keyword, if the indexes are supportive of that, the overall size of the bounce on the weekly is very soft, right? Barely like a 35% bounce. So the probabilities of the bears right now taking over and revisiting these lows or one leg lower is very high. And the same thing can be said right now about Ethereum, right? Just not a substantial bounce size just yet. Yes, you have the daily uptrend, but the overall market environment right now is just not conducive to explosive upside on a lot of these names unless you get some form of conflict resolution. So please keep that in mind for crypto. The only thing that we can possibly logically do on crypto right now is DCA if we are fans of crypto and believe in the long-term thesis. DCAing at these lower levels for longer form positions, but incredibly difficult to swing trade these. Just keep a stop loss or a trailing stop in terms of profit, guys, because you do not want to be around. You do not want to be unwound by these higher time frame bears. They're still largely in control of this trade, and they have been for like, you know, the past 6, 7, 8 months at this point in time. That's everything for your overall market rundown. I don't think we're going to have time to do the biggest gainers and losers of the day today, but I think you guys get the concept, right? If even Micron and gold and other things can't keep up, well, a lot of the popular names that have been very popular, right? Even though Light has had some tremendous price action recently, AOI, and so many other names as well, right? They may not be able to hold up if it's really something that, if the market is really just going to start indiscriminately selling off everything, right? So pay attention to that, right? Pay attention to your stop losses on these biggest gainers and losers. I'll recap that at the end of the video, guys, but not the best environment right now. When you have some rotation, fine. But when the market is giving you different signs that it may want to head into a last phase of consolidation where it just broadly sells off everything indiscriminately, then you have to be a little bit more cautious on some of your swing trades. So keep that in mind, okay? So let's move into stock number one, which is going to be good old Apple. So Apple on the day down 1.7%. Daily downtrend just simply continues at this point. The bear's just too strong right now, closing below the 200-day EMA. Support stays put all the way down to about 246. And if you breach this, you'll finally get into some of the price action territory that I enjoy selling puts into, which will be the lower 230s. Monthly consolidation between 12 and 26 would put Apple anywhere between roughly 14 to about 21% off. And that's exactly where I want to be selling puts. You'll notice that regardless of the market conditions, if we're trying to target between the 12 and 26, usually a good opportunity to be picking up Apple. I may, and I haven't done this in a long time, I may even nibble on some longer term shares in terms of Apple in this position. I haven't done it for a very long time, not since back here. So maybe if they give me a bit of a re-entry, I'll be willing to do that as well. In spite of the somewhat high valuation here at 250, I think that Apple, in terms of earnings, will have a very good year. It's just sentiment right now in the markets is quite powerful to the downside. Moving on to AMD, same concept on AMD. Nobody is doubting the long-term thesis from AMD, but the market sentiment right now is somewhat unfavorable. Although the stock was up 1.6%, there is no clarity in price action. It's just a very big chop zone. Support zone, 190 down to 180. If you come down into here, I'll be a big fan of selling some put options, 170 down to about 160. If they want to somehow come down there and pick me up and do the entire OpenAI gap fill, I'll be a big fan of being assigned down there, and we can kind of take it from there. No short-term swing trades from me. This is also an area that I would not mind adding shares to the long-term portfolios because I haven't really done that, right? Even around the $200 range, but give me 190 down to 160 again. I will be adding. The valuation is very compelling, and I will remind you, AMD is still about 1.5 cycles behind NVIDIA. AMD is still very early, guys, in terms of the big EPS ramp, in terms of the big revenue ramp. Nobody's doubting that. All we're saying is you still have to be a bit cautious in terms of sentiment, right? So going all in right here, probably not the best idea at the current moment, right? Just do it progressively scale into the position if you have a longer term thesis, because short-term swing trades on a lot of this stuff are somewhat out of the question. The price action is just not very favorable for that right now. Moving on to Amazon, same concept. Amazon, beautiful company. However, price action from the bears, very strong right now. Daily downtrend, the bulls tried, and now look, unwind. If we unwind a little bit further and lose this area, you're coming right back down here into my favorite area, which is 200 down to 190. I will be a big fan of selling some put options down there if they give me another big red day tomorrow and a higher VIX environment. Big fan of doing that. On the monthly time frame, which is the most important in my opinion, you'll notice here that Amazon at that point in time would be once again below its 26 EMA, between the 26 and the 50. Phenomenal prices all throughout history on Amazon. Business is operating on all cylinders right now. Currently, AWS strong, advertising strong, e-commerce very strong as well. Around 210 where they stand, valuation is quite compelling. Shave off another 10% off of that, and it becomes a no-brainer buy. So I will be sticking around short put options and also DCAing for the long-term portfolios on Amazon. Into Google right now, despite the fact that Google is a very strong company, right? It may not be strong enough for the market's current price action. The bulls tried to break out right here, couldn't get it done. So we are still in an environment right now. We are below the EMAs, the bears still exerting a bit of short-term control, and the weekly is still any bit of a weekly downtrend right here. My favorite area to be looking for Google improvements in price action would be around the 12 EMA. Meaning if it comes down here, not necessarily just categorically buying, but for any swing trade opportunities, that'll be the 200-day EMA. If you come down there in a rapid fashion and give me some improvements in price action, such as a nice daily uptrend, then we can set some stop losses below the structural lows and go for the upswing. But as of right now, Google still in a bit of a take profit environment or a covered call environment. The valuation around 300 is not bad, not one of the best buys in the market, but not bad. Bring me down to 275 and I may do something that I haven't done in a very long time. Maybe I'll even add a little bit of shares, but at the current time, I'm busy adding to other positions that are at much cheaper valuations. Moving on to Meta right now. Meta, another day of downside, daily downtrend well underway, getting rejected from the resistance range. 650 to about 630 is that mark. We may even come back down to the low 600s. Now, today, if you're a Meta shareholder, you should be very happy. The company just told you, listen, we're going to stop spending $4 billion, $4.5 billion per quarter on the metaverse. That capital can be used elsewhere, namely can also be used to expand their data center, either their data center footprint or various other things, their advertising algorithms and things of that nature, right? Good. You're going to be seeing more operating profits, more EPS from Meta. So effectively, the share price just got naturally cheaper. Well, not only because they're down, but also because of the cancellation of the metaverse. I don't know if they're going to rename their company again to Facebook. Maybe. I used to prefer the FB ticker much more than Meta currently, but I digress. Moving on further, support range 605 down to 550. This is the go zone, right? Either for me, for selling put options with the large account down here, big fan of that, and also adding to the long-term positions as well. Meta currently, as it stands, 620 is a no-brainer buy. And if it comes under in the mid 500s, guys, you're under 20 times forward price to earnings and almost very close to a one peg. I mean, everybody knows Meta's a no-brainer buy right now. I'm just saying the price action is very messy and it's going to be slow. So you are accumulating for the long term right here. Tough to take any swing trade longs, right? Because the price action is not conducive to that. And if you were trying to do that, well, the stop loss was breached the other day, and we talked about it as well, right? So keep that in mind. Meta still in its own form of monthly consolidation right now. It is currently a monthly head and shoulders. If they complete the pattern, it would bring you right down to the neckline, roughly around that mid 500 range, 26 EMA. Moving into Microsoft right now, also a company that is a no-brainer buy for the long term. For short-term swing trading, probably a no-go, right? Daily uptrend, the bears unwinding everything now. Daily downtrend again. So we will see, right? Whether or not Microsoft bulls are able to save this, but it's not looking very strong right now. 200 weekly EMA for the past 5-6 weeks we've been stuck here. Have we gotten any meaningful bounce whatsoever? No, only a 23.6% bounce. So yes, there's a 200 weekly EMA. Yes, there's big support, but the sentiment in the market right now is very strong. And if you do drop, you're coming quite a bit lower, substantially lower as a matter of fact, down here at about 360. So the way that I'm playing this, if we breach, I'm selling put options all the way down here on Microsoft, but I continuously add to my share position as we are not sure if it's going to actually drop down there. It's already down 30% from the highs right now, and at 410 or roughly under, I mean, take another 5% off of where we did this, right? It's around like a 23 forward PE and like a 1.2 peg, right? Which is not that bad at all for Microsoft. We should be adding, if this is part of our long-term portfolio, progressively as the stock drops. We did that last year all throughout this drop, and we were compensated for it, and that will be the case again for Microsoft. It usually doesn't get much more worse than this. If you go back in the past 15 years at least, right? Solid, high-quality company, but you know, large cap growth has been deeply out of favor in recent times, the past 2-3 months. Moving on to good old Netflix. So Netflix, surprising that it's holding up this well, right? That being said, daily, still in an uptrend right now, but if you want to look at this price action structure, right? If you start breaking down here, a little bit of daily downtrend consolidation, and we know that that's just because they're going for the weekly higher lows as well. So Netflix, I'm holding off for now in terms of any swing trades, but if we go for a little bit lower here, I'll be selling more put options in the mid 80s range. So keep that in mind if you want to do that as well. Not a bad region for Netflix. Overall, the valuation down there is quite compelling, and you can probably get some nice distance on those short puts in this market environment. The Warner Brothers deal is now off the table for them, so they'll have an extra $2.8 billion to work with, but even the sentiment in the markets right now might be too strong for Netflix's recovery, and you might be able to see a little bit more downside. Anything under between 90 and 80 bucks roughly, I'm adding to long-term shares in the long-term portfolio, but definitely no swing trade longs. Not for me just yet. I'll wait for a little bit more consolidation if they do offer. NVIDIA down 0.84% today. So still struggling. Despite all of Jensen's bullish comments, the stock is just moving nowhere, a testament to the negative sentiment in the markets right now. If you do drop, you guys know exactly where we're coming. All the areas that we've come previously, right? 170 down to 164. If you break down in this location, we were able to find, right, this last Monday, okay, we were able to find short puts down here in the low 150s. And that's something that I'm looking forward to again. Break down hard here with a heightened VIX. You may be able to find some short puts for the next few weeks in the 150 range. That would be absolutely ridiculous. It would not only blast through the 12 EMA, but to the 26 EMA as well. That would be the best market gift that you could possibly ever have. I'm not saying it's going to go down there. I'm just saying if I'm looking for short puts, I'm going very deep because this market cannot be trusted at this current time. What I am doing though, if we're building long-term shares, and if you come down there, I'll start building a bit more leap call positions as well. Some here, and if we do drop down there, a little bit more, and then I'll be full going for NVIDIA's expansion through 2027 because we know with the increasing guidance, the valuation is very compelling. It's already at a very low multiple right now, forward P of 20, right? And also the PEG ratio under 1. So still a lot of growth for NVIDIA, one of the best companies on the planet, and great visibility for the next few years. per Jensen Huang. Moving on to Tesla right now. Tesla also deeply out of favor. We are warning about this one. If you are trading this one, keep a stop loss below here, 183, because the sentiment is just not favorable. Under all the EMAs, the bull's not able to get it done. Weekly also continuously in a downtrend and still in monthly consolidation, such as many names in the market at the current time. If you do get the full breakdown, guys, you're heading to one level lower here, 360 down about 335. I don't have any swing trades active on Tesla, and I'm also not selling any put options on Tesla. I think there are many better deals in the market right now. However, if you're looking for new entry locations, down here support structure level, right? They've held the 26 for a better part of the last year and a half at this point in time. Definitely something to look into. Moving on to Palantir right now. Palantir down 1.5%, even for a company like Palantir. Sentiment just a bit too challenging. And it's a defense company. Well, it's an AI company with a heavy influence in defense right now. But if you come down below here, 148, sadly, unwinding the structure, coming back to support, daily downtrend 148 to 140. And at that point, if Palantir breaches down to this location again, the one thing I'll be doing on Palantir is selling put options way, way, way below the market, guys. I'll be targeting low 120s with the increase in VIX. You will be able to find it more likely than not. Weekly, still in the context of this weekly downtrend. The bounce size was okay, but nothing to scream home about, right? So the bulls have a lot of space here to reset. But we got to take this one day at a time on Palantir. All I'm here to say is under 130, I'll be a buyer for a little bit of shares, nibbling tiny, nothing big at all, guys, and also selling put options down here as low as I can get, just plain volatility. Moving on to SOFI right now. So SOFI CEO coming out and buying some shares yesterday after the Muddy Waters short report and also dispelling some of the concerns. They posted a statement. You guys can go see it on Twitter. That being said, SOFI, as part of the entire financials trade, out of favor. End of the day, it's a bank, right? So it's subject to the same risks that all the other banks are facing right now. Credit risks, right? Lower net interest income because of higher rates for longer, lower loan demand because of higher rates for longer, et cetera, et cetera, et cetera. Lower consumer spending, meaning lower fees, lower volumes for them, potentially. Now, it's growing still at a very fast clip, but SOFI is not immune to what's happening in the markets right now, and you should trade accordingly, right? So that being said, right now on SOFI, take it slow. 17 at about $14 is the support range. I'm still a fan of selling some put options at the bottom end of the range as far as we can get for 0.5%. Weekly, still almost, or daily, excuse me, still almost daily oversold conditions. So, right, even though we have been making slight lower lows here on the price, higher highs on the RSI, there's been bullish divergence here for a while, and it just doesn't matter, right? The stock just continues to be incrementally weaker. So this big area of support structure, be curious to see how the price action responds from here. If we're going for any swing trade longs, you got to get some price action improvement. You got to show me a daily uptrend if you want to take some swing trade longs into this location. If not, it's just wishful thinking because the bears are in full control of the short-term timeframes. On to Uber right now. Uber down 1.5%. Huge day from Uber yesterday, but once again being dragged down by the market sentiment today. So this price action, very messy. Bit of a gap fill for here from the NVIDIA news release, right? $75. And the weekly bears are still in full control of this chart. It's been a weekly downtrend for a very long time at this current stage, right? So monthly consolidation still on the table right now. And if you somehow give back this entire move, breach what I'll be looking for if we make our way down to the low 70s, not being a hero and firing off call options from here, no. I'll be playing short puts under the market into the mid 60s location with great distance. If Uber does come down there, I think that's their final resting place after a big phase of monthly consolidation. So keep that in mind. The valuation for long-term shares, I am a buyer of long-term shares in the mid to low 70s through the 60s, just due to the valuation alone. And because I'm holding these shares for the next 3 to 5 years, the earnings are good, company's doing well, but the price action and the market sentiment has been lackluster. And last but not least, Taiwan Semi, one of the best companies on the planet, suffering the same as a lot of other companies in the market right now, right? So soft, very soft. Try to get the engulfing move, try to go for the daily uptrend, no go. The bulls are just not able to get it done. We're below a lot of the moving average. If you roll over here, line in the sand is about 335, let's call it. Okay, roll over, daily downtrend, and further weekly consolidation. You unwind the entire weekly move and you close this week below the 12 EMA. It's a bit of a regime change, just like silver, just like gold. It has not done it since April, Liberation Day events, right? In spite of their great visibility, in spite of their great margins, and in spite of their great pricing power, TSM might need a little bit of consolidation. If you do give that full ride down, 313 and 300 is the area that I'll be looking for, guys. That's going to be the 12-month EMA curling up into here. It will be a very nice monthly retracement for a monthly higher low for this beautiful company. So that is the area that I'll be targeting for any either swing trades, depending on favorable price action, and also any net new shares to add to the long-term portfolio. For now, not touching TSM, not that it's not good, it's just there's many other companies that are in very much more favorable positions right now, and I'd rather just wait to see if I can get the best possible price on this one if they also do drop. So that's everything for today's video, guys. Futures market slightly green right now. Unfortunately, video is quite long right now, so not that much time to go through the biggest gainers and losers of the day. However, pay attention to the price action into tomorrow. What I don't want you guys to take away from this video is Will is super bearish. He's a perma bull. He's telling us to sell everything. I'm just saying no. I'm just saying that in this current market environment, when you're getting hints, Micron coming down after earnings, and some people say, well, the stock was up 30% after earnings. It was bound to happen. Yeah, but they destroyed it, guys. You won't find better earnings in the entire market, right? They should have at least been green. As a matter of fact, they were green for a minute there after their earnings. Still, the market sold them down. Some people will argue that maybe we're going for a back test, and that might indeed be true. These names are going to be very favorable. I'm just saying that in the short term, don't trust the price action farther than you can throw it pretty much, right? So even some of these names like Light, like AOI, the photonics names that have been working really well. These names like OSS and the drone companies, right? Such as, maybe KTOS or things like that. Things have been looking like they want to curl over. Okay, they look very good in terms of the curls that are happening right now. Bloom Energy look great for a breakout, right? And the long-term trends are indeed intact for a lot of these names. I'm just here to say that it may not be that easy to get the sustained breakouts above the highs. And as a matter of fact, I did close some of my short-term swing trades on some of these small caps that we made a lot of money in over the past few months. Number one is AMPX. I was in at $10. It was up 85%. I closed half of the position almost at the highs of the day today, just because I know that I love this stock. I have it in two different accounts. I have my long-term portfolio, and I'll hold this company probably for a few years, right? Because I got a very good entry. But the trading account for swing trades, winding a little bit of this down. TE Energy, same concept. Took a little bit of profits here, half a position in the trading account. Long-term account, I'm not touching it. But I'm in a lot of this stuff under $4, like $3.50, right? So taking half the trade off, making it free, and if we do give back, I'll gladly add back into the position. Another trade that I did that on over the course of the day today is Kraken, another one of my favorite robotics companies in the market right now. It has all of the ingredients to be a big winner in the long-term future, right? So Kraken took profit as well into Jerome Powell early this morning. It's been on a phenomenal run so far. Weekly time frame is gorgeous. Monthly time frame is deeply expanded right now. They have new contracts all over the place. However, even some of the best stocks and the best narratives, if the markets choose to embark into this final phase of consolidation that they have all the recipes for, right? Well, then the positions, even the best ones, may unwind. And as a result, I just took some profits. Like this one I was up 2x on, TE was up 2x on, AMPX was up like 80% on. So I closed half of those swing trade positions, made the positions almost free, and I will gladly add back into them if this short-term momentum across all of this stuff starts to unwind a little bit. And even some of the best names in the market recently also have their consolidation phases. Don't forget, guys, when market breadth is so weak, and when you have all the kitchen sink coming at you at the same time, even some of the best names can go through consolidation phases. I will still be playing the exact same themes that we've been talking about this entire year. I'm waiting for pullbacks, though. So all of the battery and energy storage plays, all of the robotics plays, the space and defense plays that we've been talking about at the same time, the metals, the minerals plays, right, that we've been talking about too, right? Anything that's run recently, and even some of the various semiconductor connectivity plays, such as, photonics and other names of that nature, right? All of these guys, right? We can definitely still play them, and they will be the hottest topic, but maybe now we could be expecting some consolidations. So definitely not the time to be max bidding some of these names after tremendous rallies when it's counter to the overall market breadth right now and the overall market narrative prior to, I guess, today, right? We had some good visibility. The rotations were still front and center, but more and more these days, at least this week, have been, the past times we've sold off, right, on these headlines, it's been quite weak. Matter of fact, like the conflict has gone like this, right? Big escalation in conflict. And recently, over the past 4, 5, 6 days, it's been getting a little bit more tame. You have a bit more visibility. But today, it just did like this, right? The uncertainty and the conflict resolution just went back up to 100, right? So just in a market environment right now, to be a bit cautious, take some profits where you can on your swing trades. Long-term portfolios, I'm not selling anything, not panicking, not selling long-term positions on big themes that I'm very bullish on for the next few years. No, but the trading accounts, we got to be nimble. We got to shore up the buying power, and the market's giving us an opportunity and wait for more favorable price action on the index level to kind of help us through in terms of guiding us to those next positions. But tomorrow and Friday, I promise you, we will cover more individual names, some of my favorite names, some of the levels I'll be attracted to, but that's all I had for you guys in today's video. If you enjoyed today's video, consider dropping a like. I would really appreciate it for the growth of the channel. The videos are very long, so for the algorithm to recommend them, try and give me a like would really help me out. And lastly, or rather, secondly, if you like these types of videos, consider subscribing to the channel. I would love to have you back here. We do these videos every Monday to Friday, roughly after the close. And then last but not least, if you have any comments, questions, or if you guys are looking at any specific plays, definitely leave them in the comments section. I always love reading your guys' feedback, and I'll get back to you as soon as possible in terms of replying. And last but not least, if you guys were tired of trading and investing in the markets all by yourselves, I know it's a tough environment right now. If you wanted to do so as part of a group of almost 400 members, you can consider joining our trading and investing community. The link to join us is down below in the video description. In that community, we have a lot of fun, but we trade the markets every single day and also invest in them, obviously, too, for the long-term portfolios. In the context of that, you get access to all of my trades in real time, whether they are the wheel trades that I'll be doing a lot of in the next few days, the wheel trades, the leap call option trades, the swing trades with shares, the small cap companies, the large cap companies, my long-term portfolio buys that I'm doing across many different themes, whether small cap, mid cap, or large cap. Anything that I do, guys, you get access to in real time. These are just a few excerpts of the trades we've taken in the past few weeks. So you get access to all my trades and what I'm doing in real time. You also get access to our private morning live streams every Monday to Friday. I stream live for about 2.5, 3 hours, and we go through what's happening in the market, what are the best trades for today. We trade the markets live, and then I take all of your questions on your stocks, your options, your long-term portfolios. That's the best place to ask me detailed questions, and at least I can answer you with the charts, the options chains, the fundamentals, all that good stuff. You also get access to my private video education section where I run through how I do my various trading strategies, right? More advanced wheel strategies, call debit spreads, leap call contracts, how I do my fundamental analysis, technical analysis, how to build trading portfolios depending on your risk tolerance. All of my educational content, advanced educational content that I won't put on YouTube is in that section. And last but not least, you just get to copy paste all my charts as an added benefit, right? So whenever you see any support resistance levels on the charts, whenever you see I do fundamental breakdowns like this, you can copy paste all of my watch lists, all my various watch lists, and all of my charts. It's just very simple. Takes 15, 20 seconds, couple clicks of a button, and you're done. If any of that interests you and you want to join us in the community to take your game up, a level up, right? And come join us in there, feel free. Link is down below in the video description. But that's it for me today, guys. Hopefully you enjoyed. Wishing you well tomorrow, and I'll see you tomorrow after the close. Peace.